Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me on set, we have Chris Dearborn. He's the Managing Director of Nasdaq's Markets Intelligence Desk, and we are here for the weekly review from the mid. Thank you so much. As always, my partner in crime on Fridays, and the big news today, of course, is the shutdown. Open the markets nice and strong. Shutdown and trade deal resolution was really the reason behind that. Just had the announcement with the shutdown, the 3-week suspension of it as they figure things out.
Right. The president's talking right now about it. We're not really sure of all the exact details, but the markets, if you look at the S&P index up behind us right now, it's up 0.86%. Kind of trading flat for the week, which is great. We've got 4 weeks of higher highs since the December 24th lows when the market's been taking place. And the S&Ps were up about 1% earlier. Nasdaq Composite's up a little bit more on a percentage basis for the week. So we're looking at potentially the 5th week in a row, which is the best start to the markets in over 3 decades for 2019. And with that, this could be one of those relief items that we've been looking for. You know, some of the other items we've been looking for is obviously the trade tariffs, and that's going to have a more impactful meaning to the corporate bottom lines here, and that negotiation is looking fruitful, and hopefully we'll have a deal in place by March 1st or mid-March by when it's supposed to be. And the other item that's very important right now is out of the FOMC, potentially the not tapering, but the QT put on pause. Now that's very, very important because again, you're looking at Fed rate hikes over the course of the year, and the language has changed from a more hawkish point of view in early December to a much more dovish view from late December into now, and that's what we're looking at. So that trifecta of items is kind of where we are right now, and that's what's kind of pushing the markets higher.
And this is the journal's reporting as well, that the Fed is closer to ending its balance sheet unwind. That shouldn't be a surprise to anyone, and if you look at the reaction here, maybe we've moved a couple of tenths of a percent in reaction to the shutdown headline. So it seems as if there was anticipation going into it, which is why we had that strong open. And now that it's happened, it's kind of okay. I mean, this doesn't seem to be a surprise to anyone. Now, I'm willing to bet the massive airport delays that we saw in the tri-state area this morning certainly was the catalyst by getting everyone to the table this morning, and that's what it's gonna have to take. I mean, who's to say if this is going to be resolved over the next 3 weeks?
Political instability creeping into the finance world is never good for business and never good for the markets and the economy, and that's what we've seen. The SEC has been shut down. It's affected the IPO market, right? You've seen the TSA effect on travelers, but what you haven't seen is any of that really rolling into the markets, right? The Russell 2000's up almost 10% for the year. The S&P and the Dow up over 6%. The Nasdaq Composite's up over 8%, and the beaten down Nasdaq Biotech Index, all biotechs got beaten up last year, it's up over 12%. So you're seeing the major indexes and all the underlying constituents of those indexes having a robust start. So they're really taking this in stride. So you're looking at all of that kind of like a big sigh of relief with this being shut down. But again, it's a kicking the can down the road. If it's 3 weeks, what's going to happen in 3 weeks?
Well, it's like you were saying before, the GDP has been impacted more than the wall would have cost. It's created internal instability here, you know, as divisive as ever. So it was a manufactured crisis. And I think I'm surprised that we haven't seen more of a fallout in the markets because of this, because nothing has changed since December.
It's really surprising and shows you the resilience of this market, that you can take something so enormous and impactful to the U.S. country and the markets continue to march on, knowing that it's really just a sideshow created by politicians with their eye on 2020.
Right. Well, I think I agree with what you were saying before, that the fact that the Fed is you know, close to ending its unwind, that's really what the key is here. Because I think
they're a calming factor.
Well, I mean, it's a huge factor because the biggest concern is liquidity, right? Rising interest rates, yes, we understand what that message is, but you saw what happened with the liquidity in the fixed income markets, for example, and that's really what the concern is. Because while we focus on equities, you know, a big part of our time here, the fixed income markets are tremendous. They're the largest in the world, and that's why people are so concerned about this. So I agree with you 100%. The fact that what the FOMC is doing is by far the most important part of this puzzle.
The consumer confidence level here has been eroding, and if you don't have people with their paychecks spending money, whether it's on food, whether it's paying their credit cards from Christmas, remember you had over $1.1 trillion in spend over Q4, but we never got to see those retail sales because the government was shut down. So we can't comp it. So we're looking at individual equities across the board. And again, with that, you get companies that are having winners and companies that are having losers, right? So what you're looking for is that broader picture. We're missing that, which is really turning this market into a stock picker's guide, which puts a lot of people on the sidelines because over the last 3 years, if not a little bit longer, most people have been investing in ETFs as opposed to individual names looking for that basket. And without overlying economic data put out by the government, you do not have that underlying factor to help make and drive your investment thesis.
Well, speaking of data, this is what's so interesting for next week. We have consumer confidence coming out. We have GDP coming out. We have the FOMC rate decision, which we know is going to be a no-brainer. Nothing's happening there. Key employment report on Friday as well. And then it's a packed week of earnings.
And over
There's a lot going on.
125 S&P 500 companies reporting next week. So far in the earnings season, we haven't even had 125 companies report. We've had 113. The average upside B is only 1.7%, so it's a very low bar. And what you're looking at here is a good swath of companies across different sectors that can give us a good idea of what's been happening for Q4. Companies like Microsoft, Apple, Boeing, Mondelez, GE, UPS, Caterpillar, Boeing, all staples either in the S&P 500 or the Dow Jones, which drive this market significantly higher or conversely significantly lower.
All right. It should be interesting, our conversation next Friday for sure. Thank you, as always, for joining me at MarketSite. And thank you for joining me throughout the week. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. I'm going to kick it off. We'll talk about ESG assets reached 14 trillion in 2018. Talk about how ESG